Today I would like to analyze another investment of Warren Buffett. This company is called Sirius XM. It's one of the biggest radio satellite owner in the world. And we're gonna take a look what they do. So they own a lot of shows and radio channels. We can see here the Howard Stern show, live sports coverage, talk and radio news. So they're doing a lot of things. We can also see here that Warren Buffett is the owner of this company. He has around 10% in this company, which is a big stake, I would say around 2.6 billion US dollar. And when we take a look at the stock price, we can see we are down 62% in the 5-year charts. And when we take a look at the 1-month chart, we can see we are up 21%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is a market cap of 9.18 billion US dollar, which I think is still a small company. It can leave some room to grow in the future. And when we take a look at the dividend, we have 4.08%. And we also can see that the dividend did grow many years in a row already, which is something we also like to see. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. We can see here the revenue was around 8 billion US dollar in 2020. Then we had the 8% increase in 2021, which is a really good number. Then we had the 3% increase in 2022. Then we had around 0.56 decline in 2023. And then again in 2024, around 3% decline. So overall, we have a revenue growth, I would say, but it's really looking concerning that 2 years in a row we see the revenue decline. So this is not looking great actually, but it's still a check here. The next thing we are looking for is free cash flow growth in the last 5 years. Also a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, or to pay back the debt. So we want to see that grow. And we can see here in 2020, the free cash flow was around 1.668 billion US dollar. Then we had around 3% decline in 2021. Then again, 3% decline in 2022. And then we have the strong decline around 24% in 2023. And then again, 2024 around minus 14% decline. So this is not looking great. And we want to find out the reason for that. We can ask ChatGPT and it's telling us that they have fewer subscriber and lower revenue. Yeah, we already know that. So they have a higher cost, higher capex, and they have also tough competition with other streaming services. So we can see here as well the operating cash flow declined as well, not strong as the free cash flow. This is the reason because of the capex. Here we can see it also increasing over the years. So they're investing more in the business. And we really need to see if the free cash flow keeps declining. This is not looking great. And we need to pay attention to that because many years in a row, the free cash flow declined now. And I think if this keeps going, it's looking dangerous for this company. So it's not a check here. So the next thing we are looking for is free cash flow yield over 4%. So this can also tell us about the valuation of this company. If it's under 4%, it could mean the company is overvalued right now. So what we're going to do is we're going to take the free cash flow in 2024, around 1 billion. Then we're going to divide it with the current market cap around 9.18 billion. And then we're going to get the free cash flow yield for 2024. So the number we get is around 10.89%. which is a great number, I would say. But we also have to consider the company has a declining free cash flow for many years in a row now. And if it keeps going down, it's not a great number. But 10% is a good number if it can stay at this level and is not declining in the next years. So it's a check here for me. The next thing we are looking for is debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So it's a very important number because if the company has too much debt, it can risk to go bankrupt and we don't like to see that. So what we're going to do is we're going to take the short-term debt in 2024. We can see here around 100 million. Then we're going to add the long-term debt as well, around 10.31 billion. And then we're going to divide it with the current market cap around 1 billion. So the number we get is around 10.41. So this means in a little bit over 10 years, we can pay back the debt with the free cash flow. So this is not a great number. We would like to see it under 5. So I think this company has too much debt. And we can also take a look at the cash on hand. So how much money this company has in the bank. We can see here around 162 million. So this is also not a great number, I would say, compared with the amount of debt this company has. It's not looking great. And I believe this company should pay back the debt with the free cash flow and shouldn't pay a lot of dividend right now. We can see actually they can pay the dividend with a 10.89% free cash flow yield, but I think this does not make sense. They should use this money to pay back the debt in the first place because the interest rate is high right now and they need to pay a lot of interest for this amount of debt. So it's not a check here. The next thing we're looking for is shares outstanding decrease in the last 5 years. This means the company buys back their own shares. So we want to see that if we think the company is undervalued. We don't want to see that if the company is overvalued and they buy the shares at a high price. This is not looking great. So what we can see here, they did buybacks a lot of years in a row. We can see here around 2 billion in 2019, around 1.56 billion in 2020, and then again 2021, 1.52 billion. So they use a lot of money to buy back their own shares. But if we take a look at the stock price, we can see they did these buybacks in 2019 and 2020, and the stock price was way higher. So they buy the shares around $60, and now the stock price is around $27. And we can see here, now they cannot have so much money to buy their own shares. We can see here just 600 million and then here 274 million. So this means they did a lot of buybacks some years ago and used a lot of money for an expensive stock price. And now they don't have the money to buy back their own shares because they have a lot of debt as well. So first, I think this is not a good management. You should not buy back their own shares at such a high level when the stock price looks overvalued. You should buy back their own shares if they think the company is really undervalued. And right now would be a good moment for shares buybacks. But I believe they not have enough money to do that. They have a lot of debt. So I believe the shares buybacks will slow down in the next years. So personally, I think it's not looking great. It's a check here, but I don't think it's a good management. They should do the shares buybacks in a different time. I would like to give my conclusion about this company. So let's start with a positive. So they have a free cash flow yield around 10.41%, which is looking very strong, I would say. But we also have to consider that this company had a free cash flow decline already some years in a row. Then we have the revenue growth. In the last 5 years, we had some years with a good revenue growth, but now again, 3 years in a row, the revenue decline. And we also have to consider this company has a lot of debt, around 10.41 billion. And this is a lot. And I think they have a hard time paying this debt back, especially with the debt to free cash flow ratio over 10. So this takes a lot of years, 10 years to pay back the debt with the free cash flow. But they also have the dividend. So it takes even longer if they want to pay the dividend. So in my opinion, this company is not a buy right now. Even if Warren Buffett buys this company, for me personally, I don't think it's a good buy right now. I think it's overvalued actually because they have a lot of debt. So if they would not have so much debt, this company would look cheaper. But with this amount of debt, I don't think it's a good buy right now, especially because the interest rate is expensive right now with so much debt. So I wouldn't invest in this company. I will make a video soon about companies I would invest in. So maybe keep watching my channel and see you soon.